Are you tired of the ups and downs of the cryptocurrency market? Are you looking for a way to make profits regardless of the market's direction? If so, then you need to learn about arbitrage trading. In this video, we'll take you from beginner to pro and show you how arbitrage trading can help you skyrocket your crypto profits. You'll learn everything you need to know to get started, including how arbitrage trading works, the risks involved, and the tools you need to succeed. What is arbitrage trading? Arbitrage trading involves buying and selling the same cryptocurrency on different exchanges to take advantage of price differences. When one exchange has a higher price for a cryptocurrency than another exchange, traders can buy the cryptocurrency on the cheaper exchange and sell it on the more expensive exchange, pocketing the difference in price. Arbitrage trading is a low-risk way to make profits as it does not depend on the direction of the market. How does arbitrage trading work? Arbitrage trading works by taking advantage of the price differences that exist between cryptocurrency exchanges. When a cryptocurrency is bought on one exchange, it is transferred to another exchange where it is sold at a higher price. The profit earned is the difference between the buy and sell prices minus any fees associated with the transactions. Risks involved in arbitrage trading. While arbitrage trading is a low-risk way to make profits, it is not without its risks. One of the biggest risks is the possibility of exchange rate fluctuations, which can cause the price difference between exchanges to disappear or even become negative, resulting in a loss for the trader. Additionally, there is always the risk of technical issues with exchanges, which can delay or prevent trades from being executed. Types of arbitrage trading strategies. Arbitrage trading can be broadly classified into three types: spatial arbitrage, statistical arbitrage, and triangular arbitrage. Spatial arbitrage involves buying and selling the same cryptocurrency on different exchanges located in different geographic locations. Statistical arbitrage involves identifying the patterns in price movements and buying and selling the same cryptocurrency on different exchanges based on those patterns. Triangular arbitrage involves taking advantage of price differences between three different cryptocurrencies on different exchanges. Each type of arbitrage trading strategy has its own advantages and disadvantages, and traders must choose the strategy that works best for them. Tools for successful arbitrage trading. To be a successful arbitrage trader, you need the right tools. These tools include cryptocurrency price trackers, exchange rate calculators, and trading bots. Price trackers help you identify price differences between exchanges, while exchange rate calculators help you calculate potential profits. Trading bots automate the buying and selling process, making it easier to take advantage of arbitrage opportunities. Best cryptocurrencies for arbitrage trading. Not all cryptocurrencies are suitable for arbitrage trading. Traders should look for cryptocurrencies that have a high trading volume and are listed on multiple exchanges. Bitcoin, Ethereum, Litecoin, and Ripple are some of the most popular cryptocurrencies for arbitrage trading. Traders should also keep an eye on the fees charged by exchanges for buying and selling cryptocurrencies, as high fees can eat into the profits earned through arbitrage trading. Conclusion: arbitrage trading is a proven way to make profits in the cryptocurrency market, regardless of which way the market is headed. By taking advantage of price differences between exchanges, traders can earn a profit with minimal risk. Whether you're a beginner or a pro, this video has everything you need to know to get started with arbitrage trading. Don't forget to subscribe to our channel for more informative content and join the conversation in the comments below.